one of the most common things I see in the marketplace is we get obsessed with entries, right? We get absolutely obsessed with entering the market. Okay. So why? Because when we enter the market, that's when you feel alive, right? When the market, when all of a sudden you're in, that's when you feel like the trade started. But remember, the trade doesn't start when the trade is triggered. That's not when your trade starts. Your trade starts before you're ever even in the market. I need you to write that down, right? Your trade starts before you're ever even in the market. Now, when it comes down to exit strategies, and I'm going to use a slide as a reference here. So let me pull this up real quick. Where's this thing? There we go. So I'm going to use this as a reference, and you guys can keep sharing this across your chats. But the reason exit strategies, and there's a few that you'll keep in mind, but the reason that you need to have an exit strategy and the sequence of things is everything in trading. The sequence in which you consider every aspect of a trade is everything. So before you're even plugging in where you're getting into the market, you need to know how you're getting out of the market. And you need to know how you're getting out of the market based on a stop loss. You need to know how you're getting out of the market with a take profit. And you also need to have rules in place in when you're getting out of the market manually. You want to have all of these things in place, okay? And so here, and I'm going to go over something here real quick. Let me see. Here we go. You guys should be able to see this here shortly. So, all right. So you guys want to have something like this, and we're going to focus specifically right here. This is what we're going to focus on, okay? So you want to establish your exit strategy prior to entry, okay? Prior to entry. Why? Why do you, who can tell me, right? Who can tell me in this chat right now why we want to have an exit strategy before we're ever even in the market? I want this to be engaging. I want this to be, you know, back and forth, because the way you remember the most is when you're interacting, right? You don't learn anything by writing notes. You learn it being in the action, being in the field. So risk management, so you can determine stop loss, no guessing for risk management. So as you have real understanding, so you know where the market is going. Okay, here's why. So you guys basically are on the right path. The number one reason why you set an exit before you're ever even in is so that the emotions of being inside of the market, so the emotions don't influence your exit. Because when you get into the market, that's the moment that trade is live, there's money on the line and your emotions go like this. Your emotions spike. Your emotions become an institutional candle, right? The moment that your trade is live, all of a sudden, you got your traumas came out of nowhere. All of a sudden, everything you've learned is out the window, possibly, depending on your levels of experience. So before you're ever even in, you need to understand where I'm getting out at a loss, in profit, and also manually. So look, establish your exit strategy prior to entry. Now, you also want to have a stop loss strategy, right? You want to understand how exactly am I getting out of here? So my bad, I'm muting people here. I don't know how you unmuted yourself. Impressive. So look, now stop loss strategy. As you noticed, I haven't said anything about take profits yet. Guys, the mind, right? The mind immediately focuses on best case scenario. When it comes to money, our mind immediately, like psychologically, studies show that you're gonna be optimistic when it comes to money and what's possible. You're gonna be optimistic, but we highly underestimate the worst case scenario, right? We highly underestimate this. So what happens is the following. Like I said, the reason people focus on entry so much is because that's when you feel like the trade starts, but it doesn't. Also, when you have a good entry, if it's like validation, right? One of the most toxic traits that has evolved throughout the world, especially now with how much social media, right, we consume, is validation. So when you have a good entry, you all of a sudden feel good. You get the market validates your understanding. And all of a sudden you're like, yeah, look at this entry, right? Who's ever had that? You have a good entry, market's going in profit, boom, screenshot. By the time that's posted on your Instagram, that trade hit stop loss. It's happened to all of us. It's happened to every single person here. I can almost guarantee it. Right? You're like, man, look, I got that entry, right? They're gonna see it. Everyone's gonna think I'm amazing. You look back and you're like, oh. And then you go back to your Instagram and you're like, oh, delete. Okay, well, instantly deletes the post. Right? So validation. Now I'm going to talk about stop loss strategies right now. We're going to go into exiting the market at a loss. We're going to talk about exiting the market with some gains. I'm going to talk about live trade management, and yeah, we're going to get into it. It's going to be a good session. So let's get into the market right now. When it comes down to stop loss and how you navigate this scenario. So, okay. Now, everyone here, you maybe have different ways you're entering the market, right? You might have completely different ways, and that's okay. One of the things that I need you to understand is the following. The strategy does not make the trader, right? So the entry models, the exit models, that actually isn't what pays you. It's not. Look, I've been trading a certain way since 2018. So 5 years. And my approach to the market has to do with the narrative of how money flows, right? How the people or the entities that move the market, what they want you to think, and then what they're really doing, right? So understanding, for me, it's all about the narrative. Now, you have people that trade support and resistance. You have people that trade trend lines. I don't trade that way. But both equally can have massive success. You have people who trade harmonics. You have people who trade Elliott wave. You have people who trade with a combination of indicators. Every single way, at the end of the day, we're all trading the same prices. It's like math. You can get at the end, you can get to the result in a lot of different ways. So I don't trade that way, but I need you to understand that the person who uses impulse, the person who trades smart money, or the person who trades price action, people who are trading small time frames or high time frames, all of these ways to approach the market, right? All of these ways to approach the market can have a successful end result. But the money isn't made in the strategy. The money is made in the discipline, and the money is made in risk management. That's actually where everything happens, because there's over 200 people on this session right now, and we can all take the exact same trade, but every single one of us can have an entirely different outcome, all of us, because what happens from the idea to the end result, a lot of variables. The lot size that each person uses, right? When they move their stop loss to break even, or when they trail their stop loss, where some people take partials because of scarcity mindset, because of fears, because of doubts, uncertainty, right? You get in again because of greed. By the time we get to the outcome, they can have 210 different results. So it's not about the entry, and it's not completely about the exit. It's about everything that happens before, during, and after. And so I want to give you guys some context so that this can help you. Do different strategies give you higher probabilities? Yes and no. And I'll go into this a little bit since I have you guys here. But oftentimes, and this is something that I've seen often, especially the last couple of years, the risk to reward fallacy, right? There's this risk to reward illusion. And I don't know what happened, but the last few years, this has just become crazy. But look, in theory, making 10 times more than what you risk, that's amazing, right? We can all agree with that. The 10-to-1 risk reward, yeah, that's nice. Making 25 times more than what you're risking, does that sound amazing or what? That sounds phenomenal. But it's not just about risk to reward. It's about probability of success. It's about how probable is it for that to even happen. And so you want to keep in mind that, yeah, of course, 10-to-1 sounds great. But the further the market has to go in your direction, the less likely it is to happen. So you don't really know. You don't really know if a 5-to-1 risk to reward ratio is actually what's best for you. You may not have the patience that this other person has. And so the best thing that you could possibly do is start with a lower risk to reward ratio, 2-to-1. I think that's a great place to start, 2-to-1, maybe 3-to-1, and focus on that. And I'm going to talk about that here in a little bit, but start there. And then what happens is when you have proof, when you have 50 trades, 100 trades, and you've documented all of these things. So when you have all of the proof and you go and you look back and you go, okay, cool. These 2-to-1s hit, these 2-to-1s all, and you look at all of your trades that won that month, or that 50 trades, 100 trades, and you look at the charts and you go, you know what? Had I held these 2-to-1s to 3-to-1s, some of these wouldn't have hit, but more of them would have. And actually, I would have actually made more. And now you have proof, you have the evidence that you can actually stretch your reward a little bit longer. And that's going to ultimately pay you out more. But you don't know for sure until you have the proof. We're going to get into that again. We'll get back to that, okay? But let's talk about stop losses. So where is this thing? I got a couple things open. All right, here we go. So I'll give you a baseline, right? Now, most people, this is for a bullish trend, right? And let's say we're going to take a trade over here. Okay. So now let's say we're doing something like this. So on average, if this was your previous low, let's say the market did this. Here, let me redo this. So let's say we had something like this. All right, market's trending. All right. And so we will use something like this as a stop loss. So our previous low, you can use as a stop loss. That's a safe, practical way if you're trending, right? That's one thing that you can do. Now, if you trade indices, and I'm not going to dive into this, I'm just going to I'm just going to put this out there on Go Live. I go over this all the time. But if you're trading indices like US 30, can you drop your favorite indice in the chat if you have one? All right, drop some fires if you are an indice trader. So I know we got a NAS culture, US 30. Yo, S&P gets no love. Wow. We got one. Yeah, we got one. So poor S&P, man. And S&P is the most legit too, but that's a conversation for a different day. So here's what happens. When you have correlating assets, now a correlating asset is like indices, US 30, S&P, NASDAQ. Each one of these, they actually influence each other. So kind of like Euro USD and GBP USD, right? They kind of move in unison. You guys have noticed that? So you can use those correlating assets, right? The indices, because they're all really moving slightly together. You can actually compare one chart to the other one and see and use that to place a good stop loss. So I'm going to give you an example. This is going to be a quick example. this on the right, let's just imagine this is NASDAQ. So if NASDAQ is pulling back first, let's say NASDAQ gets to our point of interest first. Let's say this is where we want to trade. But I'm going to give you guys some examples here. Right? We're waiting for the market to get to here. Let's just say that. And then we're waiting, same thing on NAS. We'll say this is NASDAQ here too. And let's say NASDAQ gets to our point of interest first. Like US 30 just hasn't done that yet. We'll just assume US 30 is over here. If NASDAQ gets here first, and we're looking at both, and they're both quality setups, I'm not going to take NASDAQ. I'm going to wait. Because if US 30 still has a little bit of room to travel, right? If let's say it's right here, right? And it still has some more. Let's say there's an imbalance. Some of you guys know what that is. But if the market has to travel a little bit more, then that will more than likely keep pushing NAS. And then NAS will go under your structure. And then you see the push. And you're like, yo, why did I just get stopped out? Man, I chose the wrong indice. Has anyone ever experienced that? Where you're like, oh my goodness. Yeah, this is divergence, exactly. Where you're like, oh, I took NAS, but it was US 30. Okay, next one. So look, this is how you avoid getting stopped out, even though it's a good setup. This is how you avoid taking the wrong setup. Compare US 30, NAS, and S&P, and then take the trade, take the asset that gets to your zone last. That's the one that's least likely to get wicked out. All right, least likely to get wicked out. So you want to have a stop loss strategy, right? For me, I trade basically 90% of my trades are indices. And I'm trading those on 1 minute time frames. My entries are on 15-second time frames. So I'm going super zoomed in, but first I start zoomed out. And in order, you can't go and get to 15-second time frame level until you understand big picture first, and then you start zooming in. So with the stop loss strategy, you want to know what works for me, right? I have my stop loss based on 1 minute time frames. But that's because I understand bigger picture, and then I go from higher time frames to lower time frames, which we call top-down analysis. So you want to have a stop loss strategy based on what it is that you trade. So if you're bullish, your entry might be here, your stop loss might be before the previous structure. If you're in a downtrend, you're downtrending like this, market's doing something like this. So you would take a trade. And your stop loss, a simple way to do it, wherever your entry is, have your stop below the previous high. Now, when would this not be the case? When would you avoid taking a trade like this? I'll show you. So and again, I'm just speaking from my experiences. Now, let's say the market's doing something like this. I'm going to tell you when I don't take a trade, right? This is exit strategies. So if I see something like this, and then the market goes crazy, and all of a sudden it's pulling back, like let's say it's chilling down here, it made a new low, and then it comes back, I wouldn't take this trade anymore. Why? Because here is where we have most people selling, right? What is known as resistance is actually what attracts retail sellers. So if it's very predictable to understand that most people are going to get in over here, because that's what's taught, then where would most people put their stop losses? Right above, right? Right above here. So there's a lot of retail money sitting here, here, here. So I wouldn't place my stop loss. I wouldn't take this trade period because there's an incentive for institutions to drive price even higher. So that's the number one reason why I wouldn't even place a stop loss there. So be careful with stop losses if you see something like this. Now, let's say your plan is like, hey, but that's still, my strategy would be to get in at something like this. Okay, well then open up your stop loss, give yourself room, because there is incentive for price to be driven beyond these highs. So let's say, whatever your strategy is, it would make sense for you to still sell here, then open up your stop loss more. Because here's the thing, guys. Remember, with a stop loss, you don't have a fixed lot size, okay? A fixed lot size is something you never, ever, ever want to have. Once upon a time, I heard that for every 0.01, for every $100, you use a 0.01. False. If you hear that, run away. Okay, run. Why? Because your risk, you want your risk to be something that's duplicatable, consistent, right? Consistent. No entry, right? No setup should ever be worth more or less. Okay, like there's some laws in trading. Okay, and here's one law. One law in trading is that we live in a game. We play a game of absolute uncertainty. Okay, we play a game of absolute uncertainty. So there is no moment that exists in this trading space where you know what's going to happen next. That does not exist. This is law. This is this is a truth. So with that being said, now through practice, right, through having proof, right, through proof, you can see, okay, this kind of setup, I do win more than others. I win maybe 30, 40% of the time, 50% of the time. And when I win, I make, 3 times more. So with that being said, as you approach the market and you're risking money, we want to make sure that we don't forget that we play a game of absolute uncertainty. So you want to risk consistent risk percentage. Now, trading your own money and trading a funded account, completely different games, guys. Those are totally different games. The way you trade passing a challenge and the way you trade when you are funded, also different. So understand that, okay? Now, we talked about, stop loss strategy and how to, what to consider when doing that. And depending on who it is that you trade with on Go Live, who it is that you follow, they probably have a slightly different technique. And so, run with the technique that you're most used to, run with the technique that you're building evidence with, because that's what's going to help you most. But so we have a stop loss strategy. Now, when it comes to stop loss strategy, there's also what we call live trade management. So here's what happens for me. There are certain things that I do when the trade is live. So I'll show you what a setup would look like for me. So this is a basic, very basic buy setup. The market's ranging, and then it clears liquidity. So it clears support, it clears retail buyers, and then the market shoots up. Okay. This creates an imbalance in the market. And let's say price could find some stability over here. Okay, something like this. And eventually it comes down. Right? Eventually the market comes down. And what is it looking for? It's looking to close out where institutions sold, drove price down to take everyone out. So it's coming for its money. So I would take an entry like this. Okay. And then, ideally market goes in our direction. So let's say this is a scenario. Okay. So here's liquidity. Here we have an institutional sell-off right there. And then I'm going to label this just for some of you to have, so you can study this later. And then you have massive push up. That's what we call imbalance. We're not here to talk about entry strategies today, but I'm going to label this since I'm right here. And then we have, break of structure here, higher highs, and your pullback. So again, stop loss strategy. So what do I do? When I'm live trading, this is what I do. This is my rule. You guys, up to you. But you want to have a rule on when the market is in your direction, right? When you're live in the market and you are in profit, the market is going your direction. You want to either know, when do I start to reduce my risk, or when do I go break even? So what does the market need to show me so that I can actually reduce what I'm risking? So let's say the market, all of a sudden we're in profit here. Let's say this was our entry, right? And we got a good entry here, sniped it, stop loss is here, and we're going for whatever. So let's say market's here, okay? You have to have your own rules. I'm going to give you mine on what would I do. At this point in time, the market's up, let's just say the market's up, 80 points. Do I go break even? Do I just, let's say my entry was right here, right? Would I move my stop loss so that I could possibly lose a little bit, but now I removed a lot of the loss potential? Do I take some partials? So you want to have absolute clear rules on what it is that you're doing. You want to know 100%, what is it that I do in this scenario? Right? What is it that I do? Where is the... So what I do is this, right? I measure how much the orchestrated move, right, which is this institutional sell, I measure how much did this, what happened here? And I go, you know what? This was a 350 point move. So that means an X amount of money was required to just drive the market down like this on purpose. So that's done intentional, right? The market can only move if there's money being put into it. So once market drives down like this, then eventually, it recovers, and the true intention, the true direction shows. When the market comes back, what I do is I go break even once the market's reversed exactly how much it dropped. Or if it's the opposite direction, then how much it went up. So if this is a 350 point drop, then I go break even after a 350 point pop, right? After it goes up. So once it reverses the distance that it originally dropped, cool, now I go break even. Why? Because at this moment, for me, I'm like, okay, well, all of the money that was used for the sell, they can take that trade. And now the money that was used there, cool, I got that money now. I can get out of that loss, and they throw it into buys, and that's why the market goes up the way that it does. So that's my rule for going break even. And this is how I eliminate losing quite a bit. Now, I might go break even more than others, but this is my way of losing, of eliminating losses. There are a lot of them. So this is one rule that I use when I'm trading live. Now, another note, something that I hear some of you use is, once you're up 1-to-1, then you go break even. That's cool too, right? That's fine. So it's whatever you have to figure out what works for you. When you're looking at this type of scenarios, what time frame? I mean, it's the same for all time frames. This kind of setup on indices, I take on the 1 minute time frame, right? And if it's correlating with the bigger picture too. But so this is an example for a buy, and then just the exact opposite for a sell. Literally this, but just flip it upside down. So that's what I do, right? That's one of my rules for managing my trade live. So everyone that's on Go Live with me, whether it's in Spanish or in English, you guys are going to say, all right, cool, guys, this has dropped 350 points. Once this reverses 350, and I'll set an alert. So let's say price is here. And I'm like, all right, cool, price. All right, guys, we see markets here. Once this gets to right here, we're going to go break even. And I set the alert. I go, okay, cool. Here's the alert. Once price is here, we're good to go. All of a sudden, let's say we're looking at something else. All of a sudden we hear that ding. All right, cool. Adjust stop loss to break even. Now we're good. Now, here's where it gets even better. Let's say this happens and you are break even. And then the market starts to do something like this, right? Market comes down again. Oh, my bad. Market works its way down. Okay. And then it starts to give us healthy structure. You know, guess what we're doing? Stop loss. When we get to here, okay, you know what? Stop loss to here now. Pull back, we see a higher high. All right, stop loss to here. Pulls back. Every time I get a higher high, I'm putting my stop loss below the previous one. And that's kind of how I start to manage it. And then worst case scenario, you still made some money. For break even, do you set it up when you are at 350 points in profits? No, that's only for this specific example, like just for this, because this is how much it was in this example. Sometimes it's 20 points, but it's not 20 points in profit. Because what if I got in over here? What if I got a really bad entry? It's how much from the low, from the recent like reversal. So where it reverses from, that's what I measure. It's not where I got in, it's where did it actually start reversing? Once I get something like this, because this is where it starts. Maybe I got a bad entry, right? If I get a bad entry, I'm still going to go break even. Now there's a chance that it could pull back and it takes me out, and it is what it is. I've decided that's what I want to do. Now, some people might not do that. Let's say you don't get the best entry, but it does go in your direction. Some people might just tighten their stop loss to the previous low and then just see if it goes. For me, I just go break even. I don't want to deal with it. All right. So when you're in profit, you move it to break even when you're up half the amount of pips of your instant. Wait, what? When you are in profit, you move it to break even when you're up half the amount of pips of your. No. So what I do is it's when the market reverses the distance of the drop. So if this dropped 100 points, if this is up 100 points, I go to break even. It's the exact amount. That's what I do. So that's how I manage my stop loss for exits. Now, what you guys are probably thinking about is like, all right, well, what about take profits? You know, like, what do I get out of it? What do I get out when it's time to make money? So that's stop loss strategy, and that's also what I call live trade management. So when the market is moving and it's fluctuating, how do you start to protect your money? You know, can you start to give yourself a better outcome? Worst case scenario, yes, right? If the market is moving in a healthy way, healthy pullbacks, extensions, retracements, you can follow along and protect your capital and ride it along like that. The better way to do this, 15-minute time frames. On the 1 minute, if you get stuck on the 1 minute time frame, sometimes remember, if we're looking at the 15, it might be doing different things. Why do you break even again? The reason I go break, wait, hold on, let me read that again. Why do you go break even again? Okay. My mindset, my philosophy is this. If the market, if the amount of money, there's a certain amount of money that drives price down. If this goes down 350 points, X amount of money is used to push the market down like that. So when price gets back to our entry, when price gets to where we want to get in, they're going to close out the sell that they opened here. So the money that they use to push price down, that's now available for them to push price up. So basically, my mindset is they're going to at least match the sell to the buy, and the market owes us at least this much. That's why I go break even, because if it gives us a push like this and then it keeps coming down, that's fine. It did the minimum. Now I can keep going up too, but at least we have that exchange of from sell to buy, and the market drove a certain amount, and all right, cool. So is that making sense? I know for some of you, you're like, yo, this is kind of beyond where I'm at right now, man. Like you might, maybe I lost you. If I did, that's okay. Because you guys can go check out bounce back. Here we go. Bounce back launch.com/. Check this out. Go there and you'll go through everything step by step by step. Also, another resource I'm going to give you right now is my pip talk. The reason being, I have a step-by-step guide on my trading style because everyone's a little bit different. All right. Everyone's a little bit different. So I have a guide here. It's like the third post. It should be right there. Here it is. The ultimate guide to my trading style. So you guys can go to here and then technical analysis. I have like a personal finance thing that like I do, how to find buys and sells, mitigation, my risk rules, how to tighten your stop loss, macro to micro entries, how to take profits, when to raise your risk to reward, how to get better at that. So, I mean, I got the whole thing, trading psychology, everything. So just go there. You guys will find it there. You can go crazy. Did you stop dropping charts? I did because I was starting to send trades on steady, but that is now not going to happen because we're working on something bigger and better with more people. So I'll keep dropping them in here going forward. So you guys can have a couple more things to study. But anyways, after that, you have take profit strategy, right? Your take profit strategy. So with your take profit strategy, there's a couple different ways that you can actually do this. And so I'm going to share my screen here. I did not realize we're going into that. We're diving in here. All right. So we got all right, cool. Exit strategy, but for getting out of the market. So there's a few different ways on how you can exit the market. And the more advanced way to get out of the market has to do with market structure. Now, the reason this is more advanced is because you have to actually know how to read the charts based on what the masses are thinking and based on what those who control price are thinking, right? There's a story. The markets are a story. There's a narrative. There's what they want you to think and what is actually happening. Always. And this is always happening, guys. There's always a narrative. Every single conversation, post, video, news event, everything has a narrative. So you always want to understand, right? Who is controlling the narrative? Who sets the rules of the game and who makes sure the game is even being played? So market structure, understanding where the market's at, that's one way to exit the market. And I'm going to go into that in a little bit. But right now, I want you to focus for the next, until you can show me 3 months of proof in a trading journal. Now, I know some of you are using mine. Shout out to all of y'all. You guys I've gotten a lot of good feedback, so I appreciate it. But based on strict risk reward. So if you are in your first, I'd say 3 to 6 months, from 0 to 3 months or 0 to 6 months, I want you to learn to practice getting out of the market at a 2 to 1. That means that you make 2 times more than what you risk. Okay. Why do I tell you that? Because you can lose 2, then win 1, and you're back at square one. Lose 2, win 1, and you're back at 0. This game is about survival. This game is about survival, guys. This is not about like anything else. Believe me. Most people they're not in the game long enough to even understand what's happening. They're not. Most people don't even give themselves the chance to make it with trading. So if you can do that, if you can give yourself, I mean, I have hundreds of people on here right now. And I'm telling you right now that this is worth it. But give yourself enough time. I want to give you a perspective. I'm gonna get into this here in a second. But hold on, how do I stop this share screen? All right, I can't see my arrow for some reason, but I want to give you guys some perspective. Now, look, most people have been programmed, they've been wired that for the last, I don't know, 12 years, right? 16 years, depending on how long you go to school, you know that college is going to be 4 years, 6 years, 8 years. You know this. Like your whole life, you've been getting prepared, mentally set that college is 4 years, 6, 8 years, depending on what you want to do. And then there's a payout, right? That's what we've been programmed to think. It's been just drilled into us. Okay. Now, trading, which is a profession, this pays out the ones that get there much better. And I'm not even talking about money. I'm also talking about time, right? The payout in freedom, in just fulfillment, in choice, just having choice. So yeah, and just in personal growth, I mean, it pays out in ways that are just intangible. So most people's expectations with trading is what actually never gives them a chance. It's the expectations. The expectations kill the possibility to even make it. And the problem is, and right now, I'm giving you the opportunity to reevaluate your expectations with these skill sets. I'm not telling you to lower the bar. No. I'm not telling you to lower the bar on the outcome. I'm telling you to raise your bar with your input. All right. So don't lower the bar with your outcomes, raise the bar with your input. What you need to do in order to get this done is probably more than you actually expected. Who you need to become, it is probably more than who you are right now. There was a point in time where I thought I was giving this the best that I had. And it wasn't until I realized that I saw someone better. And I was like, oh, cool. So my best isn't good enough yet. And that's okay. Because you can get better. You can always get better. And sometimes that's what you have to accept. Like, okay, the best of who I am right now might not be enough. But there's no limit on who we can become. So we're always going to be better. And that's okay, right? For some of us here, it might take us a year to even get to a point where something clicks. 4. I'm just being real. Like some of you here in your timeline, you will make it. Actually, everyone here could make it. The only thing is that you don't know when the making it is. On the timeline, there's key moments, right? There's key moments on the timeline. And in every single one of those key moments, there's disruptors, right? So you might be here month 6 and there's a disruption. There's blown account. There's failing a funded account. There's something happening in the family, right? There's financial crisis. There's going to be something, right? That's a before and after moment. Most people quit. Some continue. Very few. All right. At year 1, everyone's different. At year 1, you might finally be understanding the technicals. Someone else might be way past that, and they're focused. They're now figuring out their psychology. But it might take you a year to get to the technicals. I don't know. But everyone at somewhere in the timeline has that bullet point where it's, I made it. But the number one reason that most people don't is that they don't give themselves enough time to even get to that point in time. You don't even give yourself the chance. I know someone who is funded 3.2 M&Ms. And some of you get it. And he's been trading since 2012. Do you know how long it took him to actually quit his job? Drop in the chat. Let me know, how long do you think it took him to quit his job? Started in 2012. At what year? 4 years, 8 years, last year, 2022. Didn't quit his job till 2022. 10 years. But 2022, and if you follow me on Go Live or just in general, what do I tell you? The longer you consolidate, the bigger the breakout. Right? The more the market's squeezing, the longer you're in range, the bigger the breakout. 2022 was his breakout year. Okay. So in 2022, there was a moment in 2022 where 10 years happened. There was a moment in 2022 where 10 years happened. So the key characteristic to the trading game is your tolerance. It's your relentlessness. It's what can you endure. If you can do that, you can make it. But you need to be willing to change. If you want to condense, like if you want to make this happen faster, cool. Because here's the thing. I'm gonna tell you something, man. I feel you, Paula. So let me tell you something right now. Look, man, she cut my train of thought off. When this happens, right, and there's 10, 11, 12 years of growth, one thing he said was this. He said, for 4 years, I had no guidance. For 4 years, no guidance. I was just flying solo. But in 6 months of structured guidance, I did what I hadn't done in 4 years. So if you want to compress time, you're in the right place. Right? You have the educators, you have people that have the skill set, have the understanding, have a track record that can condense time, right? Your time machine is your mentorship. That's your time machine. Right? It's the mentorship that you pay for, multiplied by your consistency and effort. And that's how good your time machine works. Now, if you want to put some steroids on that time machine, if you really want to let it run, if you really want to cut your learning curve aggressively, then you need to be documenting your trades, because you can't take ownership over something you can't see. You can't take ownership over something that is just a fleeting memory. You want to be able to see your losses. You want to be able to see your wins. You want to be able to take the most out of those things. You can't get the most out of, look, one trade can give you so much more than what you're doing.